Hello everyone. So since we're all here, and thank you for attending today's webinar about Insights on Cross-Border Futures webinar series. So we have this very first session featuring Singapore. So we are co-hosting this webinar with Darling Commodity Exchange. So yeah, so basically this is the very first session of the series webinar that we're about to host honorably with Darling Commodity Exchange about this cross-border futures. Today's part, we have invited two professional panelists here. So first one, we got Miss JC Tan. She's the trading analyst of National Financial Singapore, covering the topic of exploring iron ore trading and its regulations. And also Miss Jing Hong Chong, experienced metal analyst of Stanhua Futures, speaking regarding the basic knowledge of iron ore and cross-market arbitrage. So JC will be focusing more on the general environment of iron ore as a futures product, not only listed by Darling Commodity Exchange, but also a hot product in Singapore, SGX. So while Ms. Jin will be more on analyzing the DC iron ore and arbitraging strategies. So this is the general agenda we have today right here. And so before we move on, allow me to introduce a bit about our Nanhua Futures right here. So basically Nanhua Futures Company Limited was established in 1996, listed on Shanghai Security Exchange on August of 2019. So we have with over 24 years of professional experience in providing financial futures services for CFEX, commodity exchanges, delivering service for Shanghai Futures Exchange, Darling Commodity Exchange, and the Zhengzhou Commodity Exchange. So we provide brokerage services in stock options for Shanghai Stock Exchange as well. So this is the general global topology of our company in general. So we can see we have different kind of clearing membership qualification with our overseas subsidiaries across the whole globe. So basically, in this series, we will be sharing the comparison between China's futures market and against with different regions. Like we have Singapore today as the very first one, and also we'll be sharing with different regions like against the US and also UK, London. So different places we'll be talking about in a very short. So hopefully the audience will be liking this webinar right here. And so before we move on, I will give the screen share to the first panelist right here, Miss JC. So hold on. Okay, so JC, you can go ahead and share your screen and kickstart. Thank you.
Hi, are you able to see it?
Yes, we can see and hear you clearly.
Okay, great. Yeah, afternoon. So first of all, thank you for the organizers for organizing today's event and for the opportunity to speak this afternoon. So my presentation is about exploring iron ore trading So, and its regulations. So it essentially consists of 25 slides. I'll be sharing with you on these 3 sections where I'll do a short introduction of the iron ore products offered in different exchanges, mainly on DCE and SGX. So the next part would be on the iron ore trading regulations, which includes the comparison of the pre-trade risk management and risk controls between the 2 exchanges, as well as some risk management pointers you can take note of when trading iron ore. Lastly, on how you can assess China's capital market as a overseas investors and the account opening process. So going on to the introduction of iron ore. Iron ore contracts were first listed in DCE since 2013. So in addition to the iron ore futures on DCE, SGX and Hong Kong Exchange have also carried out the trading of the iron ore derivatives, which are based on the TSI 62% CFR index with cash delivery. But in my slides, I'll be focusing more on DCE and SGX. So looking at the contract specifications, what you can see here is a comparison between the two exchanges that offers iron ore products. There are kind of structural differences between them. So DC offers the yuan-denominated iron ore contracts that are physical delivery, while for SGX, the underlying product in trading is the TSI 62%, which are cash settled in US dollar. So for DC iron ore, we always highlight to customers to take note of the contract liquidity risk, as there might be insufficient liquidity for client to exit their positions when it's close to the last trading day. So client could exit all of their positions or adjust and keep the locked positions 3 days prior to the last trading day. So what we meant by locked position is that you could hold a concurrent long and short position. So after the last trading day, your positions would be cash settled based on equal lot amount of long and short positions, while the remaining positions would participate in delivery. Therefore, if the remaining position is not in multiples of 100 as per the delivery unit, there would be a 20% penalty. Which means if you have the intention to deliver, the position should be adjusted to multiples of 100 lots. So moving on, the exchange fee for DCE, it's currently at 0.01% of contract value, which is approximately US dollar 1.8 per lot. And for SGX, the exchange fees is at about US dollars $2 per lot. So beyond the differences, which I've mentioned in my previous slide, there are other differences in terms of trading method and how the settlement price is derived. Where DCE's iron ore contracts are mostly traded electronically, unlike the SGX contracts, where more than 85% of transactions are done over the counter. So, which our company do offer trading and clearing of OTC derivatives, which I will share with you on the details in the next couple of slides. So in terms of daily settlement price for DC iron ore, it is derived via this weighted average price based on the trading prices and volume traded during the trading period. While for SGX daily settlement price, it's derived from average of these panelist submissions and screen prices. So panelist actually refers to inter-dealer brokers that are active in the market. So the OTC inter-dealer brokers will submit their prices to the exchange, and the exchange will remove the outliers and average it with the screen prices. So for iron ore trading volume, based on the trading volume for the past 2 years in DCE and SGX, there's this monthly volume peaking in July 2019 at 3.4 billion tons traded on DCE and about 200 million metric ton traded on SGX in March 2020. So in average, daily there's about 1 billion tons and 125 million ton traded in DCE and SGX. So you can see from the graph, in 2019, the trading volume was relatively high each month, which was due to record high iron ore prices amid these supply outages from top exporters in Australia and Brazil, coupled with the robust demand for steel in China. However, recently there was some domestic policy restrictions where the government restricts the amount that domestic companies can trade in order to curb the increase of iron ore prices, which is why you can see there's a dip in trading volume in 2021. But despite that, iron ore futures continue to surge higher as there's this record high steel production, rebounding global steel demand. So even with the dip in trading volume this year for DCE, but basically DCE and SGX are still the central market in iron ore trading, and it is still a very active market. So moving on, the client structure between DCE and SGX. The iron ore swap market in Singapore is an active iron ore derivative market. So the iron ore swap launched by SGX in 2009. The trading mode of iron ore swap is mostly done over the counter, with the transactions matched artificially by the brokers. So the participants composition for SGX iron ore is about 95% corporate clients, where more than 1/3 of it comes from banks and brokerage firms. The rest of it are from funds, proprietary trading house, Asian steel mills traders. So in terms of participation by geographical groups, about 1/3 of the trades were done in Singapore, 28% in China, rest of Asia at about 18%. So lastly, Europe, US at 17%. Whereas for DCE, the participant composition for DCE iron ore as a whole is at about 65% corporate clients, 35% retail clients. But in terms of international clients specifically, so since 2013, the iron ore contracts were first listed in DCE, it has attracted a big corporate investor base at about 89%, whereas the retail and asset management accounts for only 7% and 4% respectively. So the two exchanges have attracted two very different clienteles. The larger proportion of retail traders on DCE, this implies a prevalence of speculative trade through yuan-denominated accounts set by Chinese securities companies. So these retail investors, they tend to trade more frequently and can easily shift to another asset if iron ore does not provide adequate returns. So conversely, a much bigger percentage of SGX participants are institutional traders with physical exposures. So mostly hedgers and traders on SGX are more likely to have consistent physical cargoes to hedge independently, so implying a steady volume. There are also many financial institution trading on SGX, so they are thought to be more sophisticated in terms of portfolio and risk management. So as mentioned previously, that our company do offer trading and clearing of OTC derivatives. I'll go through on how the OTC market works and how you could trade SGX iron ore via the OTC market. So firstly, OTC market is over-the-counter market, and unlike the exchange, OTC has no fixed trading venue, no prescribed membership that the inter-dealer brokers have to apply from the exchange, unlike a trading or clearing membership, where they have to fulfill certain licensing requirements by the exchange. So OTC market does not have these strict controllable rules whereby contracts and quantity can be customized as per the requirement of the client. So usually when clients want to buy or sell in bulk, they could trade through OTC market and lock in a single price for that bulk order. You'll be able to get a better price than the price you see on screen. So one of the features for OTC transaction is that there is no uniform price, as the trade is matched through the IDB to form a transaction price. So the brokers play the role of market makers. So they quote the price at which the instruments are bought and sold between the participants. So secondly, the clearing is done through the SGX OTC clearing platform called OTC Titan. This OTC Titan helps to reduce this counterparty's risk of default, as ultimately it has the same features as futures contracts, whereby clients' account have to fulfill the preset trade limit based on margin requirement before the OTC trade can be approved in OTC Titan by the clearing member. Thirdly, the transaction quotations and communications are generally conducted through messaging apps. So after successful negotiation of price, the broker will enter the trade information into SGX OTC Titan system, where the clearing member would conduct verification with the client before proceeding with the clearing of trades. So what is IDB? It represents this inter-dealer broker, which can be understood as an intermediary, and being an independent player in the OTC financial market, they help to provide a point of contact for clients seeking to buy or sell financial products. So it creates these trading opportunities for customers who needs large orders. So currently, all 133 eligible IDBs of SGX can offer quotations for customers. So covering the most mainstream varieties such as iron ore, fuel oil, petrochemicals, freight, and coal. So some of our clients may ask, what is the difference between different IDBs? So the nature of the business for IDB to facilitate transactions between investors, they requires a large amount of customer resources for both buyers and sellers. Therefore, different company specializes in different types of products. In terms of the commission charges, the level of service they provide may vary as well. So the customers group behind each IDB are different as well. So generally, customers will have a couple of IDBs for price comparison, in which our company could also provide recommendation on the IDBs we work with. So these are the two scenarios where you can trade iron ore over the counter via SGX with us. So on the left side, scenario 1, we will provide a one-stop OTC market price. So you can actually approach us for any indicative prices that you are looking at, and we will get in touch with our brokers to get the best price, because we are on board with over 15 inter-dealer brokers companies. So we can actually shop around and get the best price. So once you have confirmed to proceed with the trade, we will do the same with the broker. After verifying your account has sufficient margin with us, and thereafter our broker will send a trade confirmation email to us, which we will proceed to accept and clear the trade with the exchange. So scenario 2 is a bit different in terms of who you go to for the indicative prices. And first, you will have to have an account with the IDB company. And from what I understand is that they can only onboard corporate accounts. So if you would like to trade via individual account, you can access it through H&H. So for scenario 2, you would have to directly liaise with your brokers for OTC prices and order confirmation. But subsequently, the clearing of trades, it will be done at H&H. So actually, scenario 1 will actually help to reduce your administrative time to process the onboarding requirements with several brokers. Moving on to the second part of iron ore trading regulations on how overseas investors can participate in the iron ore futures market. So there is this requirement of suitability assessment, whereby these overseas traders, they have to satisfy DCE's provisions measure for management of trader suitability, in which you would have to satisfy the requirement in knowledge tests, trading experience, and your amount of funds available. But in this case, usually foreign participants that falls under these three categories: professional investors, accredited investors, expert investors. You should be able to satisfy the requirements to participate in the trading of international products in China market. So lastly, there's also this letter of commitment to be issued by the applicant to acknowledge that they possess the required knowledge on futures trading. So after your trading account is approved and ready for trading, so in terms of trading platform, our company offers trading platforms such as ATP and CQG. So CQG is commonly used by international clients with advanced technical analysis tools and is relatively matured and stable trading platform, which is widely known among derivative traders, I would say. So for a start, the most basic platform they have is CQG Desktop, and there's a monthly cost of $25 per month, with a trading commission at 25 cents per lot, capped at $495. We also have ATP, a trading platform which currently does not have any monthly charges, but it still provides the basic trading and graph functions, and also strategy functions such as cross-market arbitrage. For market data wise, there's currently no market data charges for China exchanges. You do not require to purchase market data for trading China international products. But there's a monthly commodities quote market data charges for SGX iron ore at 20 Singapore dollars. So lastly, margin wise, our company charges margin based on exchange margin level. So there's no additional margin requirement on top of it. So I'll go through in detail on the margin charges in my next few slides. So margin currencies for China international products are in CNH. So if you have a futures trading account, your domestic and foreign margin deposits can be used concurrently. So we can provide currency conversion service. So we could deposit US dollar with us and we'll do the conversion from US dollar to CNH for you. This is how the order interface looks like on CQG and ATP. So as we mentioned previously, for China international products trading, you can hold a long and short positions concurrently. So therefore, your long trading orders is categorized into long position opening and long position closing. It's vice versa for short trading orders, which is short position opening and short position closing. So the margin for the position in the long direction and short direction will both be calculated respectively. So when it's near the last trading day, you'll have to take note if your positions are hedged. Therefore, the distinct difference in the order interface is that there is this additional function you have to select when placing orders for China international products. So the order type shows this auto, open, and close. So if you were to keep the default selection, which is auto, this means that the trading system, it will determine whether to close or open your position based on the position at our focus end. So for example, you currently have one long and one short position. If you were to place a long order set to auto, it would have closed off one of your short position, and you would ultimately be left with one long position. But if you would like to keep both your long and short position, and you would like to add on one long position, you could select one long open so that your short position wouldn't be closed off, and you would end up with two long and one short. But if you want to close off your short position, you could also select one long close. So for SGX orders, there won't be this auto open close function because SGX products are unable to hold concurrent long and short position of the same month. So one long and one short, your position will be closed off, which is basically the same as other exchanges like CME and ICE. So for exchange trading margin, we'll look at the current active contract from DCE, which is the September contract I2109. Currently, the minimum trading margin for the September futures contract is at 12%, of the contract value. For speculation at 14,046 CNY per lot, which is approximately 2170 US dollars. So for hedging, the trading margin is lower at 10%. So it's about 11,705 CNY, which is approximately 1,810 US dollars. So comparing it with SGX Iron Ore September contract, SGX does not distinguish margin based on speculation or hedging. The iron ore margin is fixed at a certain amount per lot, which is currently at 2,750 US dollars, which approximate to about 15%. So the margin amount varies every week. So each week, SGX would upload a margin schedule at their SGX website for reference. So for this slide, I'll go through some of the risk management approach for both TCE and SGX. So mainly covering on position limit, time gradient margins, successive price limit margins, and price limits. So firstly, for position limit, specifically on iron ore, TCE have a maximum amount of speculative position that can be held by each client. So it is calculated for both sides of positions. So currently the position limit is 40,000 lots for general months. But for active contract, usually the position limit would be slightly higher. So for example, if we have long position 40,000 lots and short 40,000 lots on September contract, you would have violated the position limit, as your total position on both sides should add up to only 40,000 lots. So for SGX, the recommended threshold is 3,000 lots. For these time gradient margins, this is only applicable for TCE contracts. So for commodity futures contracts entering the delivery month, exchange will gradually increase these trading margins of the contracts as per these time periods. So the 15th trading day of the month preceding the delivery month, margins would be increased to 10%. And starting from the first trading day of the delivery month, margins would be increased to 20%. So therefore, you would have to set aside more funds if you intend to hold your positions into the delivery months. For successive price limits margins, so this is also applicable for TCE contracts as well. So margins will be adjusted as per the extents and ranges of the price limit when there is this successive price limit on the contracts. So exchange may adjust the spans of the price limit on the basis of this market situation. So in the event when the price limits are touched consecutively, the exchange would raise the price limits and the margin standards. So as shown in the example below, on the first day, when the price limit is hit at 10%, margin at 11%, the second day, the price limit would be increased to 13%, and trading margins increases to 15%. So subsequently, if the price limit is hit again on day 2, the price limit on the third day would further increase to 15%, and trading margin increases to 17%. So lastly, for the initial price limits, TCE Iron Ore has a price limit of plus minus 10% from previous day settlement price. And for SGX, there's iron ore currently there's no price limit. So a brief understanding on the exchange risk control towards a clearing member. This DC exchange requires clearing member from time to time, so depends on market situations, to increase our margin available at the exchange. So if our margin available is low, or if the market risk has significantly increased. So for the exchange, they have this risk warning system. So when they deem necessary, they will take measures to report this situation to clearing members by sending us reminders or issue risk warning. But whereas for SGX, the exchange performs 3 intraday margin cycles daily. So in the morning and afternoon for current day trades and positions, and once after the end of day settlement cycle that includes trades for next day clearing. So in terms of risk control towards clients, our company's futures account are leveraged. So the amount of initial margin required to place a new trade is only a small percentage of this total contract value, which means trading limit is equivalent to the amount of funds you have in your futures trading account. So for the intraday risk, our company's risk policy is that if your equity is lesser than your initial margin, you would be considered as having margin call. So if it's lesser than 50%, your account is on low equity. When it's 30% and below, your account would be subjected to forced liquidation. Therefore, we would encourage to practice a good risk management by taking proactive steps to cope with volatile market conditions and uncertainties. So in this last session, I'll be sharing with you how overseas investors can assess China's capital market and the account opening process. So just a brief background. So we have this, we pretty much have offices in most global financial centers in US, Chicago, in UK, London. So, we also have HNH first established in Hong Kong in 2006, and subsequently our Singapore office was set up in 2017. So we have a wide range of financial services ranging from exchange traded futures, options products, leverage foreign exchange, OTC, commodity trading, and asset management as well. So in Nanhua Futures, we provide extensive exchanges to suit your trading needs. So we are the clearing members for over 10 exchanges globally, namely the Hong Kong Exchange, CME Group, ICUS, LME, SGX, Apex, DME, and 5 of the exchanges in China. We are also the trading members for SGX, Apex, ICE Europe, Eurex, Euronext. So with this enhanced direct hub access into exchanges around the world, you'll be able to access a comprehensive range of financial products to meet your investment needs. So as China is gradually opening its markets to overseas investors, foreign participants must meet certain criteria involving this capital expertise experience. So with this internationalization of iron ore futures, it helps to enrich and perfect the structure of the domestic iron ore futures market. So it actually reflects the real change in the supply and demand relationship. It provides the iron ore trading participants with a fairer and transparent price benchmark. So this helps to expand the depth in iron ore futures, serving the real economy. So because HNH Singapore is the overseas intermediaries, so for overseas investors, you'll be able to participate in China market through HNH Singapore and then to Nanhua Futures, as they are one of the clearing members of the China exchanges, and lastly through the clearing members. So the trade will be cleared with the exchange directly. Therefore, a NRA bank account is not required unless you would like to trade directly with the clearing members of China. So in HNH, we provide comprehensive trading and clearing services on major global exchanges. So we have this one-stop service for global investors to participate in China market, where we have this guided account opening process and consultation on your trading needs. So following through towards settlement and clearing of trades with the exchange, you could access the futures market or through HNH, be it global exchanges or China market exchanges, as since we are the clearing members for over 10 exchanges globally. So we also have this all-in-one trading application, so we can trade products both from China market as well as overseas market in a single trading application. So it's either via this ATP or CQG. So if you would like to try out the platform functions, we have demo accounts available as well. Lastly, moving on to the account setup process, which is rather simple, starting with providing us with the documentation required for overseas corporate or individual investors. So we would then submit for an internal qualification review to determine if you meet the requirements for trading in the China exchanges. There is also this DC knowledge test you would have to complete so as to able to trade in specified domestic futures product. But you could also choose to provide a letter of indemnity instead. So other requirements such as proof of available funds, trading experiences, and other requirements for corporate clients or individual clients. So subsequently, we will submit the application to the exchanges for regulatory review and the application of trading ID. Once that is approved, we will set up the trading account in the trading platform, which is either ATP or CQG, and you will be able to start trading. But do note that before applying for China's specific products trading account, you would first need to have a regular trading account with us in order to meet the margin requirement for 5 consecutive trading days before the application of this trading ID with China's exchanges, as this is one of the application requirements. So if you have any other questions on account opening for China's market, you could contact our account manager and he will be able to assist you with that. So yeah, thanks for your time.
Okay, thank you, JC, for sharing such useful and also professional insights on both sides, both on the SGX and also the DC side. So at least I think for me personally, I would think 2 things that are coming quite helpful for me personally. So first one is I think the SGX, the OTC side is really something for me like good to know, because like the OTC contracts are not like so much talked in China. So when SGX have the OTC contracts, then overseas clients can reach out to Exchange Singapore, and then they will find the better IDB for the better price, so they can execute the OTC contract in a better way. Like the entire trade flow to me is very useful right here, and I also think on the DCE side, the comparison between the trading interface, with the ATP and the CQG comparison is really helpful, not only to me and also for I think for all the overseas investors we have get in touch with for now, because like the opening position and the opening instruction and the closing instruction is like the one and only thing that the Chinese futures market have, that is like completely different with the like the ICE or the CME and also SGX does. So it's really like a common question that the overseas investor will be having in terms of like the real-time trading when they actually put their hands on it, the computer. So